nightmare is going to be persistent going into the future. Like, there is no way in the world that the Federal Reserve is going to position anything within the monetary policy or the economy or any expectations within the financial conditions of there to bring inflation down to the 2% target. That was never the goal. And I've tried to share that with people many times here on this channel, but it's very hard to internalize that information when you have so much mainstream media narrative that is pushing the exact opposite. Now, I have tried to share on this channel for years now how it is that the Federal Reserve was stuck at the lower bound of zero and they needed elevated inflation expectation to raise the neutral interest rate off that lower bound of zero, and that is what would give them their ammunition back and give them the ability to adjust rates going into the future to try and stimulate the economy. But very few people had realized that the Federal Reserve desperately needed inflation to take place in order for them to achieve that return of monetary policy back to their arsenal. Now, I'm going to leave a link down in the description to a recent speech given by Philip Jefferson. This was October 3rd, so just recently, just a week ago. Economic outlook and the Fed's monetary policy framework. Now, this is something that we are going to eventually, here in the next few days, hopefully before the weekend, this is going to be a speech that we are going to do in a members-only live stream where we break down the entire speech. But there was one section in here that I really wanted to share with you guys because I think it's incredibly telling about the situation we are now facing. This is the monetary policy section of this speech. It says, while tariff-related inflation is apparent in the prices of goods, tariff increases typically represent a one-time change in the price level. The scope of the persistence of the related rise in inflation will be determined by several factors, including the final tariff rates, the extent of pass-through to consumer prices, the effects on supply chains, overall economic conditions, and what happens to longer run inflation expectations. Now remember, expectations is a huge input into all the inflation that we are now experiencing. Remember, inflation expectation is a self-fulfilling prophecy. If you feel it, believe it, and know that inflation is coming, you will conduct yourself in a way that really brings the inflation on anyway. All right, short-term inflation expectations have come down from its peak reached in the second quarter, and most measures of long-term inflation expectations have been largely stable, suggesting that the American people understand our commitment to returning inflation to our 2% target. Now, this is very interesting because everybody is under the belief that the Federal Reserve is attempting to get that inflation down to a 2% target. Like, they are trying to achieve 2% inflation and no other target is in mind, no other idea of what it is that they want to do with inflation. It's 2%, only 2%, nothing but 2%. And I have been one to try and share that they are going, or that they were, not necessarily now, but we're using something called the makeup strategy, which was going to allow inflation to run extra hot, extra long for an extended period of time to make up for the shortfalls that they had experienced. Now, trying to internalize this gets very confusing. I get it, right? But to understand that the Fed was stuck at that lower bound of zero and desperately needed inflation to raise that neutral interest rate so that they could get their ammunition back, that inflation expectation and inflation must be persistent going into the future. It can't just end now. It has to be continuous. Now, I know this is really crazy for a lot of people to try and think like, no, the Fed is trying to get to a 2% target. They will achieve it. Once they get there, they're going to try and maintain that. That is not what the Federal Reserve is even believing that they can do. Listen to this. As such, right, this is what he just said, suggesting that the American people understand our commitment. The American people understand this. Now, whether or not they believe it or not, I don't know, but they understand that the Federal Reserve is committed to this idea of this 2% target. It says it right here. The American people understand our commitment to returning inflation to our 2% target. Now, listen to this. As such, I expect that the disinflation process to resume after this year and inflation to return to the 2% target in the coming years. Did you guys get that? In the coming years, not even this year, next year, maybe not even the year after that, in the coming years, the Federal Reserve will get to the 2% target. Persistently high inflation forever. This is what the Federal Reserve is trying to do, is continuously have elevated inflation. Now, they don't want it so high that it causes painful experiences for everybody across the land, even though that's what a lot of people would say, but they do not want it low. That's the key. They do not want low inflation. They want high inflation. And if it's running above the 2% target, that's working for them. A lot of times people will misunderstand this. When you think about the Federal Reserve and how it is that they are conducting monetary policy, there was a time where they would try to lower interest rates to get more people working. When more people would work, more people would earn money. By earning more money, they would start purchasing more stuff. By purchasing more stuff, the supply-demand imbalances would take place and the inflationary pressure was found. That is how the Federal Reserve used to conduct themselves, knowing that they could take interest rates to the lower bound of zero, take unemployment to historically low levels from the Obama administration all the way through the Trump administration going into COVID, historically low unemployment, and it failed to produce an inflationary scenario for the Federal Reserve. This is why most people end up missing it. They have no understanding about how it is that the Federal Reserve was locked in at a lower bound of zero with no ability to adjust monetary policy with interest rates. It was all about deploying words, forward guidance, signaling, jawboning, incredible threat of asset purchases, the quantitative easing, delivered the message to the people that created an inflation expectation that was incredibly elevated, but it did not produce the inflation that the Federal Reserve was needing. There was a great speech given by John Williams, New York Fed president. He gave the speech back in 2018, right? And monetary policy strategies for a low neutral interest rate world explained so much about what it was that the Federal Reserve was facing, how it is that they were going to be facing some serious issues going into the future if they did not raise the inflation expectation. It says it right here, right? Today, we face an altogether different set of problems stemming from a very low neutral interest rate, that is the short-term real interest rate, consistent with an economy operating at its potential alongside low and stable inflation. Ironically, the problem we need to solve these days is a risk of inflation that is persistently too low rather than too high. This is the New York Fed president, John Williams, making this statement November of 2018. Think about what has occurred since then. Inflation expectation that is persistently high. This is the problem that the Fed was looking to have. The problem that they faced today was an inflation expectation that was persistently too low rather than too high. That was the message that he delivered in November of 2018. Man, did he not get what he was looking for? All right. What does the low neutral rate mean for monetary policy and the anchoring of inflation expectation? When a recession hits, central banks may not be able to reduce interest rates well below their neutral level to stimulate the economy as warranted by the effective lower bound. The lower bound is zero. The neutral interest rate was very close to zero. The neutral interest rate is the rate that neither accommodates nor restricting the economy, and the Federal Reserve hit the lower bound of zero and was not far enough below neutral to actually stimulate the economy. That's what he is saying right here, November of 2018. Right? When a recession hits, central banks may not be able to reduce interest rates well below their neutral level to stimulate the economy as warranted by the effective lower bound on nominal interest rates. That was him right there admitting the Federal Reserve has no room to adjust monetary policy with interest rates. It's not an effective tool. Goes on to say, this shortfall of monetary accommodations would result in less desirable economic outcomes during the recession and recovery. In particular, inflation would typically undershoot its desired target during these episodes. The persistence of below target inflation rates in many advanced economies over the past decade is a testament to this dynamic. I don't know how many people realized it, but when the Federal Reserve was finding the inflationary scenario within the economy that everybody was scared of and believing that it was going to destroy the world, that is exactly what the Federal Reserve needed. That inflation nightmare that everybody was feeling, the pain and suffering that came from it, was exactly what the Federal Reserve was needing. And they knew they were going to do this to you. They knew they were going to do it to you, and Powell admits that. He admits it in 2020, August of 2020. Powell said it straight up in a speech. Let me see if I got it here. Says it right here. Now, this is before the inflation took place. Remember, this is August of 2020. The pandemic is just kicking in. People had no idea, like the supply chains were just starting to break down. The inflation had not hit dramatically yet. Like it was coming. A lot of people saw it, but it hadn't happened yet. This is what he had to say. The persistent undershoot of, again, this is August 27th of 2020, coming directly from Jerome Powell. This is a speech that he gave, right? In fact, what is the title of the speech? New Economic Challenges in the Fed's Monetary Policy Review, August 27th of 2020. Right? Get this. He straight up says it. The persistent undershoot of inflation from a 2% long-run objective is a cause for concern. The undershoot of inflation, it means it was running persistently too low. This is a cause for concern. This is what Jerome Powell is saying. Many find it counterintuitive that the Fed would want to push up inflation. Hell, counterintuitive. Some people didn't even believe you could do it. All right? Like you couldn't, like all the quantitative easing 1, 2, 3, and 4, and the extra low interest rate environment for an extended period of time failed to produce an inflationary scenario. Many people find it counterintuitive that the Fed would want to. Hell, some people didn't even believe you could do it. All right? After all, a low and stable inflation is essential for a well-functioning economy, and we are certainly mindful of that higher prices for essential items such as food, gasoline, and shelter add to the burdens faced by many families, especially those struggling with lost jobs and income. Right there. He said, hey, an inflationary scenario is going to create pain and suffering for the many families out there struggling with lost jobs and incomes. I mean, he straight up says it before it happened. We know. We're mindful. It's going to take place. Right? It's going to take place. If we have this inflationary scenario that is running persistent going into the future, it's going to elevate the food, it's going to elevate the energy prices, and all these people who have low incomes and lost jobs are going to suffer the consequences of that. The people at the end of the line. You think about it. He doesn't say, hey, the people at the rich are going to suffer. No, he says everybody who is poor is going to suffer this situation. However, a big however, I mean, yeah, you guys are going to suffer a lot of pain and misery and suffer. You're going to suffer. However, inflation that is persistently too low can pose serious risks for the economy. Right? I mean, it poses serious risk for you being poor and, losing your job and all that other stuff. It poses serious pain for you, but it also poses a serious risk to the broader economy. The people who end up being a little frustrated with those higher prices and like they earn the money, but, it's kind of annoying to them. I mean, who's suffering the most here? However, inflation that is persistently too low can pose a serious risk to the economy. Inflation that runs below its desired level can lead to an unwelcome fall in long-term inflation expectations, which in turn can pull actual inflation even lower, resulting in an adverse cycle of lower inflation and inflation expectations. So they're like, man, we don't like the low inflation. We don't like the low inflation expectations. We like high inflation. We want higher inflation from here on out. And we are very mindful that it is going to cause pain and suffering and misery for the people at the end of the line. That's too bad. They got to save their monetary policy. And really, the best way for them to save their monetary policy is to convince everybody that hyperinflation is around the corner, because that will raise the inflation expectation. It worked. It totally worked for them. It totally worked. In fact, it worked so well that they don't even need to talk about the lower bound anymore. They removed it from the consensus statement. In fact, let's go back and look at Jefferson's speech there. When did he say that? Where was it? Oh, he lost it. There it is. Oops, get back here. All right. So even in his most recent speech, the one that we were just covering from Philip Jefferson given October 3rd, this is what he had to say. I mean, they talk about the effective lower bound in this speech. They even talk about the makeup strategy in this speech. Like, literally, Jefferson brings it up. He talks about the makeup strategy. Here, I'll just read it. I mean, I was going to break this down in a members-only live stream, but this information is too valuable to keep secret. See, this is the reason why I even do this channel, is so that I can share this information with you guys so you can internalize it for yourself, so you can make the appropriate decisions for yourself. This is too good to keep secret, right? Like, it has to come out in... Anyway, it says this. First, the revised consensus statement removed language emphasizing the effective lower bound as a defining feature of the economic landscape. It used to be a problem. It was a major problem, the effective lower bound. We know this because the neutral interest rate was very close to the effective lower bound, and by lowering interest rates to zero, they were not able to stimulate the economy. The effective lower bound was a problem. It's no longer a problem. Why? Because interest rates are elevated based on the inflation expectation and the persistence of it going into the economy. Okay? Goes on to say it. Instead, states that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. This revision, reflecting a move away from the post-financial crisis era of historically low interest rates, makes our framework more robust. It is useful to recall that at the time the FOMC previous framework review during 2019 and 2020, policymakers were considering an economy that had for many years demonstrated low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slacken the economy. The overreaching concern for central bankers at the time was how to operate when short-term interest rates are near the effective lower bound. That was the problem that they faced back then. It was like, crap, what do? We were out of monetary policy through interest rate adjustments when we were at the effective lower bound. This is him saying it just a few days ago, that issue that they were facing is not the problem that they face today. Right? Goes on, today, of course, we are operating in a very different environment, at least in part brought on by the economic consequences of COVID-19 pandemic. Now, this is where he admits it straight up, that they were letting inflation run extra hot, extra long for an extended period of time. They did it on purpose, knowing that they had to do it. I mean, John Williams admitted that they were going to be pushing it up through the monetary policy strategies for a low neutral interest rate world speech, but then they had something called the makeup strategy, literally to make up for the fact that they failed to achieve that 2% target. They were going to let inflation run extra hot, extra long for an extended period of time, and they had a plan to do it. Then COVID kicked in, severed the supply chain, and inflation ran up. The makeup strategy essentially became irrelevant. They were like, well, we don't have to deploy the strategy. COVID's doing it for us. Says here, the revised framework embraces a flexible inflation targeting approach at all times and eliminates a quote, make-up strategy that would be employed in certain circumstances. They don't need it anymore. Right? The experience of the U.S. economy since the pandemic highlights different challenges to achieving our inflation mandate, such as supply shocks, sectoral developments, and the godly, inflation dynamics. The flexible inflation targeting strategy outlined in our revised framework allows us to take a balanced approach in promoting our goals by considering the extent of the departures from them. The revised framework appropriately emphasizes the committee's commitment to ensuring that long-term inflation expectations remain well anchored. So now, understanding that was the case, the Federal Reserve was trying to make up for the fact that they failed to achieve the 2% target. They had a strategy for it. The flexible inflation targeting approach is what they used in order to succeed in that ability to raise the inflation expectations while at the same time maintaining long-term inflation expectations anchored at that 2%. That challenge, they were successful at. It was the hardest thing that they had probably ever tried to do, and through the mainstream media narrative, it worked. They got it. They totally got it. So again, let's go back and look at Jefferson's speech real quick, because that's where I was at, right here. In the fact that he says this, right? He says short-term inflation expectations have come down from their peaks reached in the second quarter, and most measures of long-term inflation expectations have been largely stable. So again, brought the current inflation expectations somewhat down and have locked in that longer-term inflation expectation at 2%. Two different things happening there, right? Current inflation and long-term inflation. The long-term inflation locked in at 2%. Current inflation coming down. Okay? Suggesting that the American people understand our commitment to returning inflation to our 2% target. As such, I expect the disinflation process, that's inflation, you still have inflation, but instead of having 6% inflation, you got 5%, 4%, 3%, that's disinflation, right? You're still getting inflation, but you're getting less of it, right? Says, as such, I expect the disinflation process to resume after this year and inflation to return to the 2% target in the coming years. That means persistently high inflation for the next few years. Right? This is what he expects. One of the voting members of the FOMC. Right? I don't know how many other people see it this way, but this is how I have been seeing it. This is what has given me the ability to call out the lumber market as easily as I have. This is how I was able to use this information to position myself in a way that I am now doing better than I have ever done before. And it's all because I have internalized this information and making decisions based on my understanding of monetary policy and not that of the mainstream media narrative, because the mainstream media narrative is there to deliver propagandized information. And it works. It so works. Okay. What do you guys have to say? 175 people watching with 43 likes. Continue to hit that like button. All right. Do you first see gold and silver going up with the dollar for the foreseeable future, or will they devalue the dollar to stimulate economy around the world? Here's an interesting thing to think about. Like, if you go into a situation in which that they are going to stimulate the economy, generally that is done through asset purchases, which means that they are going to be buying into the U.S. bond market. If you are buying into the U.S. bond market, what you are going to do is you're going to drive yields down and the prices up. And if people are very much aware, informed, and confident that the Federal Reserve will pull that trigger and move in that direction, they will attempt to front run the Federal Reserve, and it'll drive the bond values up and the yields even further down, right? In that case, the speculation that people are using within gold may then flow into the U.S. Treasury market. Now, think about it. The U.S. Treasury market is generally a completely different type of investor than the gold market, right? The gold is a speculation. There is no return, there is no rent, there is no business involved with it. It's just an item that you have purchased that you intend to sell for a higher price going into the future. So this is what they refer to as a dumb asset. Not because you're stupid for buying it, and it's not, and when they say that you're going to sell it, the greater fool theory, that you're going to sell it to another fool, these things sound bad, but it's just the terms that they use. To understand that it's just an item that somebody else is going to pay a higher price for, that doesn't have an investment to it. That is a speculation. An investment has a yield, it has a rent, it has a business model behind it. It has something that says, hey, if I deploy this money, then I should get a return of money somehow, right? Again, whether it's in dividend payment or a rent payment or a business that you own. So these are two completely different types of assets, gold and treasuries. Now, when you have a situation in which that treasury yields are going to fall and fall dramatically, the yield itself is not the attractiveness of that particular asset. Because the yields are falling, you don't get a bigger return, right? When yields rise, you get the bigger return. So when yields are falling, it's not that in which that the investors are looking for. The speculators see that and they say, hey, if we buy into U.S. treasuries and the yields continue to go down, we will be able to sell these treasuries for a higher price. That is a speculative asset. Now you have a completely different mindset. Gold is the safe haven. But many people see the gold prices moving up and they want to take advantage of that price move. And so they start speculating into that idea. That is not the same as buying it for a safe haven. Very much like buying into U.S. treasuries is not a safe haven if the yields are falling and people are anticipating that they're going to sell that asset for a higher price. This is a speculation. Okay? And so to understand what has taken place in the market could be two different mindsets, but the results are the same. All right? Depending on the reasonings for getting into it. All right. So back to the question, do I see them for the foreseeable future? Yeah, for at least the time. Or will they devalue the dollar to stimulate the economy around the world? Yeah. And yes, absolutely. Dollar devaluation is baked into the cake. Like there's no real other direction that they could attempt to take the monetary policy. However, the ability to weaken the currency becomes a very difficult task when you have dollar-denominated debt that is demanding those dollars to pay off that debt. Like if people are literally trying to get out of the dollar, they will need to demand the dollar first to get out of that position. Okay? And this is where I think a lot of times people are like, oh man, the dollar is done, it's cooked, it's out, nobody's going to want it anymore. If they go into devaluation, you're guaranteed hyperinflationary scenario. And then all that consideration doesn't take any idea or incorporate any idea of the dollar denominated debt that exists outside of the country. Like, there's two things happening here, at the same time, and you can't ignore one or the other. You have to look at both of them. Dollar is already down 10% this year, another 10%, and additional 5% in inflation coming. If your dollar gets devalued, then your assets also lose money, or house, cars worth less, 1 million you paid for now worth 600,000, big problem. Well, that's not generally how the devaluation works. What the problem, like, I don't think it's the assets that are the problem. It's the purchasing power that comes from it later on in the future, right? So, like, this is like the major concern coming from Greenspan back in the day, is that they can guarantee any cash benefits to anybody at any time. Like they can, the United States can pay any bill. There is zero chance of default. They have a printing press. They can just pay any bill they want. The problem that comes from it is the purchasing power from those assets. So you might have $1 million in U.S. treasuries saying, oh man, look at all the assets that I have. But the $1 million itself may not be able to purchase anything going into the future. And that's the concern, right? So even if you have assets that gone up in price, if you have a weakened currency, then it doesn't matter how much those assets have come up. you don't have a purchasing power with it. Right? And that's the unfortunateness that comes from it. You actually have to have people productive. You have to have productive people in the nation producing, providing services, doing the work. You have to have those people in the economy. All the people can't just sit there and be loaded up on assets and say, oh, we all have $1 million. Now none of us have to work anymore. It won't provide you with any kind of benefit, right? There will be nothing to buy, essentially, because you got to have people who are providing products and services. And if you don't have that within the economy, or you have less of that, or the people who are working those particular industries are not getting paid enough to actually provide them with the way of life, then the whole system becomes eroded and difficult to operate in. You'll have to have ever increasing amounts of asset yield returns coming into your portfolio just to maintain your standard of living, only to find that there's less and less products and services out there that are people are providing because they simply just don't have a way of life because of it. This is the separation that's happened. It's going to continue. Like, there's no way it can't. That's the scariest part. There's no way that it can't not continue to separate. Like, the inequality, the wedge of inequality will definitely continue going into the future, and there is nothing that can be done to change it, because the thing that would be needed to be done would be so devastating for everybody out there that not a single person will vote for that outcome. They will vote for government to do something. The moment that they vote for government to do something, the government starts going into debt, they're deploying money, and the separation occurs. So literally, the people begging for the government to do something is going to cause the pain to be worse. If they didn't, the pain would be overwhelming. All right? That's all there is to it. I mean, the Fed knows, right? However, the pain and suffering and misery by low household incomes with low income and no money, whatever, they suffer the most. Everybody else can be a bit frustrated. All right. Will King Dollar destroy everything in the short term? No, probably not in the short term, no. What's going to happen is that people are literally going to try and get out of the dollar. When that happens, people anticipate that there's going to be this flood of dollars coming back to the United States, right? This is the nightmare scenario when the chickens come home to roost, right? That's what they say, when the whole world gives up on the dollar. The problem that they are not addressing is that there is nothing else to replace the dollar. Even if they wanted to, they're like, hey, screw the dollar. Crap, man, we can't do transactions because there's not enough of any other kind of currency out here. There's literally nothing else to use. Even if you wanted to use the BRICS nations, they don't have enough of it out there to provide for all the transactions. What is needed is a safe and liquid asset like U.S. Treasury debt. And in order to provide the world with enough U.S. Treasury debt, you have to have a nation willing to go into debt as deep as the United States has done. No country wants to do that. Nobody likes the idea of it. They don't even like the United States doing it, let alone, hey, man, maybe we'll give this advantage to some other nation out there. Like, it won't happen. Right? That ain't going to happen like that. The dollar is it. There's nothing else, and there's nothing that's going to replace it anytime and going into the future. However, the idea of getting out of the dollar is a real concept. The problem with that is in order to get out of the dollar, like say, for example, you're yourself, you want to get out of the dollar, you don't want to use the dollar anymore, but you got a car loan, you got a mortgage debt, you got student debt, you got credit card debt, right? Now, I don't want to be in the dollar anymore, but I got to pay off these debts, which means that I have to earn dollars enough to pay off these debts. That demands dollars. Now, all these debts, they get used. These assets that you're like, I got this mortgage debt that I got to pay, this credit card debt, this car loan debt, this student loan debt, those assets get traded out there on the market. This acts like currency. So not only do you have the dollars that you need to get to pay off those assets, but those assets are acting like dollars as well. So the moment that you pay that off, right, you have acquired the dollars to do it, you have paid that off, not only are you taking dollars out of the system because you need them, right, they're just going to strengthen the dollar as you try to grab a hold of them to pay off your debts, but the moment that you start paying off these debts, it's removing dollars out of the system. So tell me, how strong can the dollar get as people try to get out of the dollar? As they have all these dollar-denominated debts that they have to pay off that are acting like dollars out there, The person who is needing to pay that off is going to strengthen the dollar by literally trying to acquire those dollars, working for dollars, trading for dollars, doing everything they can to get a hold of the dollars to pay off the debts. And the moment that they pay off the debts, the dollars start disappearing from the system. Tell me, how strong can the dollar get after that? If that was to be persistent going into the future. There is far more debt than there is dollars to pay it off. But if everybody tries to get out of the debt, what's going to happen to the dollar? It's going to strengthen. What chickens could possibly come home to roost if there's more debt out there than there is dollars to pay them? All the debt gets paid, there's no more dollars to even come home to roost. Right? And people say, oh, well, they'll just default on those bonds. No, they won't. You start defaulting on those bonds, it causes a contagion around the entire world. The whole financial system collapses. There's no way that'll happen either. I mean, I'm not saying that it won't happen. What I'm saying is like that will be just as devastating as any other collapse. All right. A literal 900-page document laid it out in advance. They still voted for it. Suck it up, Buttercup. People are virtue signaling about getting out of the dollar. Yeah, I mean, well, what time is it? Oh, gee whiz, guys, I got to get going here in just a minute. All right. We as humans are stuck on Earth. Nobody going anywhere anytime soon and long from now. Dirt is pretty finite. It's what this administration wants, writing on the wall. Huh. I don't see that way. I really don't. Everything that I've seen the administration do is push an inflation expectation through the credible threat of tariffs that is benefiting the Federal Reserve. The administration is pushing credible threats of tariffs that is raising the inflation expectation that is benefiting the Federal Reserve. The Federal Reserve needed elevated inflation expectations, and they are getting it from the administration through the credible threat of tariffs. I don't know how many ways I can say it for you. All right. Will unsecured debt become a thing of the past? Oh, that's interesting. I doubt it. I really doubt it. I think that the cleverness of debt issuance will only grow more persistent into the future, right? Like, I wouldn't be surprised if they figured out a way to get credit to little tiny kids, so they could buy candy and stuff on credit, so they can be locked in before they even become an adult. All right, Trump likes tariffs because he's an 80s guy. All right, Kool-Aid, everyone with assets is not the administration, it's the Cantillon effect. Absolutely, Brody. Simon, are you saying that the inflation expectation is causing the inflation to go up, not more money printing? I am saying that it is the credible threat of tariffs, supply chain breakdowns, and the idea of what it is that people believe that the Federal Reserve does with their money printer that is causing the inflation expectations to rise, and which is in turn creating an inflationary scenario. Now, if you want to say it's money printer that causes the inflation, then I'm going to ask you to please explain again how it is that the Federal Reserve expanded their balance sheet of $850 billion to over $4.5 trillion during quantitative easing 1, 2, 3, and 4 after the great financial crisis, and suffered major problem with their monetary policy from the lack of inflation. Here they printed up all this money, spit it all out there for everybody to absorb the idea that they were going to create this inflationary scenario, hyperinflationary scenario, and it failed them miserably. Can you please explain that, deplorable? Because I've tried many times. I don't know if you can. Most people end up getting stuck on the money printer causes inflation. And then they can't explain quantitative easing 1, 2, 3, and 4 failing to produce the inflationary scenario for the Fed. I mean, I've done it so many times on this channel. That is what I am saying. Inflation expectations based on the supply chain breakdown from the credible threats of tariffs is creating the inflationary scenario that we are facing today. People are acting preemptively to try and deal with the tariffs before they actually done anything, and it has created a problem within the people's mindsets, within the economy, and the ability for them to understand why it is that inflation is running persistent. It's because it's stuck in their head, right? There's no inflation in lumber. Like, there's no inflation in lumber. There's no inflation in oil. Like, there's no inflation in those two products, right? I mean, two vital commodities known to man. There's no inflation in them. Speculation into silver's running hot right now, still making its all-time high of 50 years ago, like almost 50 years ago. It's so funny to think about like what it is that the dollar is doing to people's mindsets on what it is that is happening with prices, happening in inflation, and happening with asset prices, happening in within those commodities. So many people have just internalized it so simply that if they put out a bunch of money, that will create the inflationary scenario. And if you take that into consideration as the only reason, you're actually benefiting the Fed, right? You're benefiting the Federal Reserve. Money has to enter all channels at the same time in every way in order for an additional money supply to create the inflationary scenario. That way, if you bail out the corporations, you bail out the rich, you bail out the poor, you bail out the government, you bail out all these people all at once, then those people inject money all at the same time. But if you have quantitative easing 1, 2, 3, and 4 after the great financial crisis, where you expand the balance sheet of these big banks and you load up those big banks' balance sheets with a bunch of reserves, and those reserves need to be lent into the system in order to have them chasing goods and services, well, then you only have that money going in little directions, little areas. Not the little, they're actually big areas. But for the most part, the majority of the people don't get to experience it. All right? You have to borrow the money and buy real estate, bonds, stocks, all that other stuff. And then you saw the inflation if you were sitting in those particular positions. That's where the money flowed to. So it's not just money printer go burr, prices go up, money printer go burr, and then how is it directed into the economy? That is a huge difference. All right? Because just because the money printer go burr doesn't mean prices go up. Quantitative easing 1, 2, 3, and 4 prove that. I got to go back to work, guys. I would love to hang out. There's a super chat here. I'm going to read that real quick, and then we got to go. All right. What are your thoughts on Goldilocks? They realized Oklahoma and Arizona and Idaho joining. The also released a Dallas... Oh, Goldbacks. I'm sorry. I thought it said Goldilocks. Goldbacks with Texas precious metals. Use them, replacing the dollar here. Well, to be honest with you, the Goldbacks, I think they're cool. I think they're unique. They're a nice, like, souvenir kind of thing. Like, you know, but really, it's... for those of you who don't know what a Goldback is, they look like a dollar bill or like money. They're very thin, and they're made of gold, right? It's like, you know, actual gold piece, you know, but they look kind of like a bill, like a reserve note or something of that nature. And the idea behind it is it makes it easier to spend. But in my opinion, there's not much difference between a gold back and a gold coin. In fact, there is no difference between them. All right? Just because of the shape of it and the, you know, the markings on it might give it something a little different, but the underlying asset itself, the gold, isn't any different than if it's, you know, a chunk of gold from the ground, a gold coin, or this gold back. It doesn't, or even a digital gold, like, you know, using on a credit card. They're all the same. They all act the same way. Understanding that gold is not going to be a benefit to a debtor nation like the United States. Like a consumer debtor nation like the United States is, if we were to switch to a gold standard, we would import stuff and export our gold, and we would be broke almost immediately. Not a good idea. Using gold, silver, precious metals as an insurance policy to exit out of the third-party risk, that third-party claim, like you don't have to call anybody to get your money. You don't have to worry about the envelope coming in the mail. You don't have to trust anything or anybody out there. That third-party risk is eliminated. There is no third-party claim. So once you see it in that fashion, then gold and silver can be used as an insurance policy. You're not thinking of it as commerce. Not only could it not really exist in commerce in the United States, because again, you would export all your gold when you import stuff, and in turn of it, we have two different currencies working at the same time, fiat currency and gold. Gresham's law says that gold will get hoarded and the fiat currency would be the one deployed. So in my opinion, I think they're cool. Like I have a couple of them, and my boy actually purchased one. And, you know, I think they're a neat item. But as far as being useful in the economy, outside of the insurance policy, like I've always thought about precious metals, I don't know what it would do. All righty, you guys are awesome. Thank you so much for that super chat. I really appreciate all the support. Links are down in the description. Thank you for hitting that thumbs up button. By hitting that thumbs up button, the YouTube algorithm grabs the video, spreads it around for more people to join in, and sharing the video. I know when sharing the video, YouTube loves sharing the video as well. So when you share this video with your friends, you got YouTube also grabbing the video to share it around for everybody to see. Thank you so much for being here. Uneducated Economist, you guys let me know.